at the Department of the Treasury and those viewing via webcast. I'm Tyler Curtis, Director of the Office of Consumer Policy here at Treasury, and I'll serve as moderator for today's meeting, which focuses on measuring the effectiveness of financial education and literacy programs. You should all have a copy of today's agenda. I will note that there is one change to the agenda, which is that the Secretary will join us later in the meeting, as he is currently tied up with another commitment. We will start with introductory remarks from the Deputy Secretary of the Treasury, Michael Falkender. We will then hear from Mark Calabria, Senior Advisor to the Acting Director of the Consumer Financial Protection Bureau and Vice Chair of the FLEC. We will then hear from Acting Chairman of the Federal Deposit Insurance Corporation, Travis Hill, Acting Comptroller of the Currency, Rodney Hood, and Chairman of the National Credit Union Administration, Kyle Haltman. We will then have a panel discussion on measuring the effectiveness of financial education and literacy programs, moderated by Professor Anna Maria Lusardi. Deputy Secretary.
Thanks very much, and thank you everybody for being with us, both in person and via the webcast. Here at Treasury, we believe that expanding access to economic opportunity is one of the most important ways that we can strengthen communities across our great country. Promoting financial literacy is about empowering individuals to build wealth, achieve financial independence, and realize the limitless opportunities that our nation provides. This is a shared goal across all of our agencies. One of the great strengths of Treasury as an institution is its convening power, which is why I was eager to join Secretary Bessent today and emphasize the need for harmonious government action to promote financial literacy at the first convening of the FLEC during President Trump's second term. As was indicated, the Secretary is currently at the White House, but will be joining us shortly to speak about measuring the effectiveness of financial education and literacy programs. During President Trump's first term, I had the honor of also serving in this building as the Assistant Secretary for Economic Policy. Played a leading role in the 2020 negotiations and implementation of the CARES Act. The CARES Act programs not only helped millions of Americans meet their immediate needs, like maintaining employment and keeping food on the table, they also led to benefits persisting far longer than a single payment. When the FDIC conducted its national survey of unbanked and underbanked households in June of 2021, it found that government payments like the economic impact payments issued by the IRS contributed to more than 1/3 of recently banked households opening a bank account. This shows how federal programs can promote inclusion in the financial system, helping people better manage their money, save, and access other financial tools. It demonstrates the responsibility that is shared across all our agencies to lead by example. As Deputy Secretary, I now serve as the Chief Operating Officer of the Department, implementing every aspect of Treasury authority, from tax administration to coordinating financial regulation across the federal government. That job includes making sure that all Americans understand why the government is leading the way down this final stretch of the transition from paper checks to secure digital payments. This effort builds directly on the lessons of the CARES Act, which highlighted that modernizing payments can serve multiple goals at once. It reduces costs, it improves efficiency and security, and it promotes financial access. In fiscal year 2024, Treasury dispersed over 97% of all of its payments electronically. While that sounds like a large number, given that we process about 1.3 billion payments annually, that still leaves about 40 million checks that the federal government issued last year. Ending the use of paper checks has the potential to save the federal government hundreds of millions of dollars each year, and it presents an opportunity to further promote financial inclusion by encouraging adoption of bank accounts and other digital financial services. Moving to digital payments is not only more efficient and less costly, it is also more secure. Check fraud poses a significant risk to consumers. Historically, paper Treasury checks are 16 times more likely to be reported lost or stolen, returned undeliverable, or altered relative to an electronic funds transfer. Check fraud is also becoming more common, with banks issuing about 680,000 reports of check fraud in 2022, nearly double the number of reports from just 1 year earlier. In response to the uptick in check fraud, Treasury implemented enhanced processing using machine learning AI to speed up identification and recovery of altered Treasury checks. While Treasury is detecting and recovering the overwhelming majority of potentially fraudulent payments, the pace of theft has continued to increase. As your agencies develop their implementation plans for the recent executive order on modernizing payments, I hope you will also leverage the golden opportunity to educate the public about both the risks of paper checks, the benefits of faster and more secure digital payments, and as I have been saying to more and more people every day, teach them dual-factor authentication. I want to thank all of you for being here today and your commitment to this important work. Your leadership is critical as we continue to find new ways to promote financial empowerment across all communities. I look forward to working together to ensure that every American, no matter where they live or where they start, has a real chance to achieve prosperity. Thank you for being with us today.
Thank you, Deputy Secretary. Mr. Calabria.
Thank you, Mr. Deputy Secretary. I guess Mr. Acting IRS Commissioner, and I'm starting to feel like you may be the only person who has more jobs than me. So I to appreciate and sympathy for that. I want to extend
Secretary Rubio would correct you.
True. He'll be added as a commission member soon. But I want to extend my welcome to my fellow commissioners, many of which I consider close friends. So it's great to be able to spend some time with you this afternoon. And I really do want to thank the panelists presenting today. I believe that financial literacy, when done correctly, is quite frankly the most effective form of consumer protection, really enabling consumers to properly evaluate the financial choices and risks in front of them. I will also note that the foundation of most of our consumer financial protection statutes is disclosure. And the effectiveness of disclosure ultimately rests upon the ability of the consumer to utilize the information disclosed. So I really do see consumer education, financial literacy as a core element of not only the financial literacy objectives of CFPB, but the overall set of objectives for the agency. That said, as often in Washington, we kind of confuse ends for means. Financial education, while at its heart is a means for improving financial literacy, the purpose is not simply to increase knowledge, notwithstanding that importance, but also to improve consumer decision-making and behavior. We want people to be able to make better informed decisions. I'll note, given one of my other hats, we do spend considerable sums on financial education. But I want to argue that dollars should not necessarily be our measure of success. They're a measure of cost. For instance, I'll note that leading up to the financial crisis of 2008, I believe we at HUD increased housing counseling spending by over 500%. Was that effective leading into the crisis? So ultimately, the question to me, and I hope that this is something that the panel reads upon, is are the financial literacy efforts that we engage in and spend considerable resources on actually changing decision-making by consumers? Are they better informing consumers? Are we ultimately having a consumer that can protect themselves? And of course, ultimately, this is not a philosophical, but rather an empirical question. And again, one I look forward to hearing from the panel on. Thank you, Mr. Deputy Secretary.
Thank you, Mr. Calabria. Acting Chairman Hill.
Good afternoon, everyone. I appreciate the opportunity to address the Financial Literacy and Education Commission today and would like to thank Treasury Secretary Bessent, Deputy Secretary Falconer, members of the FLEC team, and fellow commission members for the opportunity to participate in this important dialogue. National research indicates that a significant portion of the population lacks basic financial literacy, struggles to accumulate emergency savings, and faces obstacles in achieving long-term financial stability. Recent years have also seen key shifts in how Americans manage their money. For example, over the past decade, the use of mobile banking as the primary method of account access has increased almost ninefold. There continues to be a need for high-quality, objective financial education. Like the Department of Treasury and other federal agencies, the FDIC plays a role in these efforts, primarily through its Money Smart financial education program. The Money Smart program has been around for 25 years and provides financial education curricula to banks, schools, colleges, and other stakeholders. It focuses on financial knowledge, budgeting and saving, and credit management, among other areas. The administration's recent executive order on modernizing payments to and from America's bank account may also present an opportunity to promote banking relationships. In response to the pandemic, the FDIC worked on an interagency basis with the Treasury Department and IRS to encourage consumers to open bank accounts and receive their government stimulus payments via direct deposit. I want to thank the experts that will be featured as part of the program today, which includes one of FDIC's own senior consumer researchers. The FDIC supports efforts to ensure that all Americans have the knowledge and tools to participate confidently in the banking system, and we look forward to continuing this important work with the Commission and its members. Thank you.
Mr. Hood.
Great. Good afternoon, ladies and gentlemen. I'd like to begin by thanking Secretary Bessent and Deputy Secretary Falklander for hosting today's meeting. I am indeed pleased to be here with my colleagues on the Financial Literacy and Education Commission. The Office of the Comptroller of the Currency was created in 1863 during Abraham Lincoln's presidency to create a safe, sound, and reliable banking and monetary system to help unify our nation. The OCC's work today stems from this founding purpose. Our mission is to ensure that the more than 1,000 institutions we supervise operate in a safe and sound manner, provide fair access to financial services, treat customers fairly, and comply with applicable laws and regulations. Financial literacy education plays a key part of driving financial inclusion and participation in our nation's financial system. Financial education empowers more people to better use financial products and services to manage their day-to-day needs, access capital to invest in themselves, their businesses, and their communities, as well as build wealth for themselves and future generations. Financial literacy helps consumers to preserve their well-being by avoiding frauds and scams. And financial inclusion can help children and youth gain the fundamental skills and practices that will benefit them as they mature. The OCC has long supported the banking system's efforts to promote financial education for their customers and the communities by providing information and resources on best practices, such as our quarterly financial literacy update, our insights report on financial capability and other financial literacy topics, as well as our online resource directories. Our staff also facilitates connections between banks and community partners by organizing outreach events and training sessions throughout the United States. In fact, just a few weeks ago, I was very pleased to work with my colleagues where we went to Hyattsville, Maryland for a junior achievement program where I was able to address a group of 13-year-olds about the importance of financial education. OCC publications and resource directories point to best practices for financial literacy and education programs that emphasize the importance of evaluating the program's impact and effectiveness. Additionally, the OCC encourages banks to consider how they can support customers' financial health and well-being. To do so, banks may look for ways to understand their customers' challenges, consider opportunities to provide responsive products and services, and take other steps to support customer efforts to improve their financial position. I quoted about Abraham Lincoln creating our agency. I'd like to now have a quote by him as well, and that is, "The best way to predict the future is to create it," end quote. In the banking sector and beyond, innovative technologies can create a future of delivering helpful financial products to consumers in ways that are safe, sound, and cost efficient. Everyone in the financial ecosystem, including a lot of the financial educators here today, should carefully monitor the rapidly changing financial marketplace and update financial education strategies accordingly. For example, in 2023, almost 5% of all households owned or used cryptocurrency, with more than 9 in 10 of those holding it as an investment. Given the level of interest, expanding financial literacy resources to address digital asset investments may be quite useful and helpful. Financial educators and asset-building organizations can consider how to leverage interest in investing in digital assets to help consumers consider opportunities to engage in this evolving product. Digital asset investors may be first-time investors, so I think it's going to be useful to draw upon other investor education efforts to help these new investors succeed. I indeed look forward to hearing from FLEC members and panelists on this topic today. The OCC is pleased to work with our colleagues in the FLEC to highlight innovative and effective financial education resources to promote sustained financial well-being for all of America's citizens. Thank you to the Treasury Department and again to Secretary Bessent and Deputy Secretary Falklander for this wonderful opportunity to address this august body. Thank you.
Thank you, Kyle Hauptman, Chairman of NCUA. I want to thank my colleagues at Treasury and the other members of this commission for this important discussion, and just as important, how we actually measure the effectiveness of these things. I also just love being in this room. Shout out to my friend Rodney Hood for mentioning digital assets, not just the investor side of it, but the payments aspect. Someday we're going to have another crisis like the stimulus payments, and real-time payments, secure, are going to be very useful in that. I've got a brief opening statement that I'll mention a few things happening at NCUA. Many of us were raised such that it's crass to talk about money, maybe embarrassing as well, and in some circumstances it probably is. But the reason it's important for couples and families to have good financial habits is because money discussions often aren't just about money itself. They're about things like keeping families intact, surviving a financial emergency, or pursuing a better life that might involve a risky career change. And money can be a life and death matter. Financial stress is strongly correlated to higher blood pressure, causing heart disease and other cardiovascular problems, not to mention the mental health aspects. Essentially, financial security is an amazing product that's available on the market for purchase via saving and investing. It may be the only product that delivers peace of mind, career opportunities, better sleep, and a lower divorce rate. But one reason we're here today is that product called financial security is, even for people making decent wages, it's competing against the American consumer economy, the world's undisputed champion of finding ways to get cash out of our wallets. Regarding our work at NCUA, we try to do our part. We have webinars every few months. We had one last week for older Americans to discuss retirement planning. I'm also proud that NCUA just did a small thing that helps homeless veterans have access to financial opportunities. In a recent letter to the Defense Credit Union Council, I reminded them of what the BSA AML regulations say regarding ID. The NCUA didn't change a rule or practice. I clarified what the current regs say about an issue that could make more credit unions feel comfortable opening an account for a homeless veteran who has only a VA card and no fixed address. We clarified that the address and the contact information of their caseworker at the VA is sufficient to open the account. And I'd be remiss if I didn't mention that NCUA was merely following in the footsteps of the FDIC, which offered similar guidance a few years back. By working with credit unions and those seeking charters, we can ensure more individuals have banking options and access to trustworthy services. In a study by the ABA, 38% of those surveyed said they learned the most about money from family, 15% from school, and 11% from social media. But what if you don't have financially literate family members, or you don't learn in school about it? Social media offers a great deal of information and other things. How does a person know who to trust? The cooperative nature of credit unions lends itself to filling this gap for its members. Credit unions are one of the original answers to the challenge of financial inclusion. At NCUA, we encourage credit union expansion in communities that have been underserved. The first credit union ever in the United States was started by French-Canadian mill workers in New Hampshire who wanted to bank at a place that literally spoke their language. The same thing is true today. Just last week, we granted a new charter to the African Diaspora Credit Union. When we talk about financial institutions working on financial education, the nature of that institution can matter a lot. And I think we all agree we do not want to be one of those countries that just has a handful of large banks and that's it. This country, as vast and diverse as it is, needs a wide variety of financial service providers. Earlier this year, NCUA data showed 54% of credit unions that we supervise offer financial education to members, with a third offering workshops, and more than half of them providing financial counseling. These are promising, and they reflect the cooperative nature of the credit union movement. As nonprofit entities, every dollar counts. Credit unions have to make sure the money they invest in these programs result in improved literacy and increased financial knowledge for their communities. Effective financial education and literary programs amplify the positive community effect and provide the opportunity to provide more community members in the banking system. As members of this commission, we're all committed to promoting the essential tools financial education provides. I enjoy hearing more about how we can better measure outcomes, so I appreciate the chance to be here today. Thank you.
Thank you very much. Let me take this opportunity to thank my colleagues, Vice Chair Calabria, Chairman Hill, Comptroller Hood, and Chairman Hauptman for those opening remarks. As the Vice Chair said, it's incredibly important that we identify what is effective and not merely measure success based upon the money that is spent. And so that's why the panel that we're about to hear from is so timely. because the topic is measuring the effectiveness of financial education and literacy programs. And so with that, I'd like to invite the panelists to come up to the panel. The panel is going to be chaired or moderated by Dr. Anna Maria Lusardi, Senior Fellow and Director of Financial Decision Making Initiative and Professor of the Economics Department in Stanford University. The panelists are going to include Jerry Walsh, the President of FINRA Investor Education Foundation and Senior Vice President of Investor Education at FINRA, David Birnbaum, Deputy Assistant Secretary for Housing Counseling at the Department of Housing and Urban Development, Susan Burhouse, Senior Consumer Researcher, Division of Depositor and Consumer Protection at the FDIC, and Dr. Beth Darius, Program Analyst, Financial Readiness, Office of the Deputy Assistant Secretary of Defense at the Defense Department. So with that, Dr. Lusardi, look forward to having you chair this session.
Thank you very much. It's really exciting to be here today. It's an honor to chair this very important panel. And I have to say, yes, it's very exciting as well to be in the cash room to talk about financial literacy. Participants today will talk about the important work that they have been done, and I have to say I'm really impressed by what some of these agencies have really done, and over time, this is a project, many of these projects have been going on over time, and it's really important what they have achieved and hear about what they have achieved. I say it's really high time to talk about financial education, because as the data shows, we want to change the statistics about financial literacy to make sure that people have the skills and knowledge to build wealth, to build prosperity, to achieve prosperity, and use modernized method of payment, and yes, know about the dual factor authentication as well. And it's so exciting as well to read about the interest of Secretary Bessent about financial literacy. I see it in his writing as well. And I know how important FLAC has been in coordinating all of the work on financial literacy across the federal agency. I want to echo what some of you have said before and use the word of my student athletes, and in particular the football player, who say that financial literacy is really the best line of defense when it comes to make good financial decisions and really protect against potential problems, including scams. And I want to in particularly start with a short presentation to set the stage. But let me state from the very beginning that the academic research is quite clear in showing how effective, and I would say cost-effective, financial education has been, and perhaps to use a quote from Benjamin Franklin to really show that indeed financial literacy pays a good rate of return and potentially the best rate of return. In my presentation today, I want to describe some of the data that we have collected over time to really set the stage for the presentation we are going to see. And I want to start with the initiative we have launched at Stanford. This is a joint effort across 3 different departments: the Business School, the Stanford Institute for Economic Policy Research, which is the Policy Institute, and also the Department of Economics. Our mission is really, or we envision, a world where people are financially informed so they can achieve objectives, including financial freedoms. And we really want to transform personal finance education, in particular provide a basis, a rigorous basis, so we can make sure it is assessed and we can indeed always do better in equipping our young people with the skill and knowledge that is required today. The reason why it's so important to do so, we just released today the 9th wave of the Personal Finance Index. We collect this data each year in January to assess what's the level of personal finance knowledge. And we do so with as many as 28 questions. So we have a very granular information about the 8 areas in which people routinely make financial decisions. And the reason why I say, and I said we need to change the statistics, as you can see here, overall, the level of financial literacy has been probably relatively, I would say, not still at the level that we would like to see, and in particularly, it has been relatively stable over time. And we want to make sure that everybody knows these topics and everybody is equipped to indeed make good financial decisions. There are groups that show also lower level of financial literacy than the general population. One of the group, of course, we are very passionate about are the young, and this is why, for example, we have started courses, and this is why I'm so excited to hear some of the program that we'll hear about today, but also those with lower income and lower education face more challenges when it comes to this specific knowledge that everybody needs to have today. We know, and I wanted to again echo what was mentioned earlier, that financial literacy does matter. It's linked to a set of behavior that's important for the economy, not just for the stability of individual. We see that financial literacy is linked to having precautionary saving, to be able to manage that, to be able to plan for the future. And we see that this has implication not just for individual, but also for the economies as well. Just to give you a sense of the potential cost of financial illiteracy and why we might want to indeed, in addition to the school, also speak about financial education in the workplace. And I know we'll hear this again in the panel. If you look just at the simple cost, the numbers of hours per week that people spend in dealing with personal finance problem is really high. And 7 hours per week are spent dealing with personal finance questions. And this is why when we think of financial freedom, we also think freedom from worries. And as many as 5 hours are spent at work dealing with personal finance decisions. Another reason why, to increase the productivity of our labor force, we also want to make sure that we have a population which is financially literate. And again, our research looking at all of the financial education program, the more rigorous program done so far, have really shown that financial literacy is cost effective. And we have learned a lot from seeing what others have done. So I have to say, we have the tools now to make financial education effective. And I hope we can see more and more programs done, not just at the, for example, school level, but also, for example, in the workplace and in all places where people go to get information. For example, libraries, for example, website, and I know all of the institutions represented here offer so much information available to them. We are also providing this many information on our website, so invite all of you to also look at the initiative for financial decision making. But let me turn now to Jerry, because her important work with the National Financial Capability Study provides us actually with data, very rich data, and a very large sample that I think can be the basis for assessing the effectiveness of programs.
Thank you so much, Anna, and thank you all for having me here today. It is an honor and a privilege. For those who might not know FINRA, we are the Financial Industry Regulatory Authority. We're a not-for-profit, non-governmental regulator of one small slice of the financial markets, the broker-dealers that sell stocks, bonds, mutual funds, and other investments. And the foundation is a wholly owned subsidiary, which I have the great good honor to run. And I have had the great good honor to collaborate with virtually everybody around the table and on this panel on financial literacy research and financial literacy outreach efforts. So while the Foundation's overall mission is to help all Americans build the financial stability to be able to participate in our capital markets and feel safe once they're there, to build wealth and protect wealth, we do that through education and outreach and research and training programs, but a signature element of what we do is research. And I could talk all day about the Foundation's research, but I'll hone in now on the National Financial Capability Study, which we call the NFCS, and I will probably use that acronym because there are way too many syllables in National Financial Capability Study. But basically, it's a triennial survey that was launched in 2009. It was actually the brainchild of a group of people, the President's Council on Financial Literacy, which was formed by President Bush. It was the first President's Council on Financial Literacy. There were subsequent ones. But it was pretty exciting, and it's exciting to have Dan Iannicola because he was the executive director of the President's Council at the time that the FINRA Foundation started to do this research. Anna was one of our consultants, and the President's Council very much wanted the FINRA Foundation to collaborate with Treasury and other agencies. So it's really in this room, this beautiful room that I am also thrilled to be in, that the NFCS got born. But as Anna mentioned, it is a large survey, 27,000 respondents per wave, and we're now on our 6th wave. The 2024 data will be released on July 17th. You can slice and dice that data any of many ways, including state by state, because there's at least 500 respondents per state. So for local initiatives, that's really important to be able to establish some benchmarks for what they're doing. But you can also slice and dice it by demographics, by age, by gender, some of the vulnerability groups that Anna was talking about, employment status, certain products that you own and that you manage. So you can really hone in on particular areas that fall within the remit of your agency. There's also an investor study, and we had the great good fortune to work with the SEC on thinking about some of the questions that are important to ask investors. One of the things that we do is we make the data freely available, not just the reports, but anyone can download and use statistical tools. There are some data that, in order to protect respondent privacy, we aggregate or we omit from the publicly available sample, but we make those data available to researchers who sign a data use agreement with us. So all of it's freely available. What we measure is financial knowledge, but really financial capability, which is broader than financial knowledge. It's a nuanced concept that really gets into knowledge, behavior, attitudes, access to financial products. And the 4 pillars are making ends meet, planning ahead, managing financial products, and financial knowledge itself. Some of the questions get to characteristics. We include, for example, a question that establishes veteran status, whether you're a homeowner. We also include the financial well-being scale that the CFPB developed. This wave, we have some new questions that will cover topics like artificial intelligence, crypto assets, ownership of, but also attitudes toward. And then also buy now, pay later. So some of the things that are more topical. So you can compare wave to wave because there's sort of a core of questions that we consistently ask. But as different issues are emerging, we ask questions about those. And so the 2021 wave, for example, had questions about COVID. As I mentioned, the report will be coming out soon, but I don't want you all to wait. I have a couple of tidbits just to tickle interest in the release coming up in about a month's time. Very consistent with what Anna was talking about, we see consistently, wave over wave, that people who have higher levels of financial knowledge are much more likely to be engaging in positive financial behaviors, and they're much less likely to be engaging in negative behaviors. And so for things like emergency savings, you see the light blue line is far higher than the dark blue line. The light blue line is the line with high financial literacy. When it comes to spending more than income, you see that people who have lower levels of financial literacy are much more likely, almost 50% more likely to be spending more than their income. And that's true regardless of income level. The percentage of people at the below $25,000 household income is pretty much the same regardless of financial knowledge. But over 100,000 K in household income, you still see a marked difference. Lower financial literacy is correlated with a likelihood to be spending and not saving more than you make. When it comes to making end meet, the 24 data do show something that I think none of us will be surprised by. Americans are having a more difficult time making ends meet. The survey was in the field from June through October of 2024, and you see that about 7 percentage points higher in 2024 than in 2021, and it had been fairly consistent since the very first wave, which was shortly after the financial crisis. We also, slicing that by age, see that particularly our younger people, the 18 to 34 demographic, are having the hardest time. About 33% of that demographic are spending more than they make. There's some good news, and this might not seem like good news, but you saw a pretty consistent financial knowledge level in Anna's PFIN data. We had seen a decline in financial knowledge from 2009 to 2021, but in 2024 it's leveling off, and that's good news. Still, though, the bad news is that barely a quarter of people could answer 5 of 7 questions correctly. Again, a little more good news. People were more familiar with the concept of inflation. They at least knew the answer to the inflation question. And you see a pretty significant increase, particularly among younger people who are understanding that. But the data is available for all 50 states and nationally. On our website for Financial Literacy Month, we did a sneak preview. I want to talk a little bit before I end and turn it back over to Anna about how agencies and organizations can use the National Financial Capability Study to measure impact. The big 5 questions, which Anna helped develop based on the big 3 that she and other researchers had developed, are included. The CFPB Financial Wellbeing Scale is in there, the short version. All of that can be used by any program. The questions are on our website, freely available, so that you can use those to do pre-post testing, for example. You can also do benchmarking. So if there's a particular audience, if you're focused on wage earners, if you're focused on homeowners, if you're focused on people in a particular demographic or people in a particular geographical area, you can use the national sample and the sample over time to do a benchmark against the audience that you're seeking to serve. We do also have longitudinal data because the NFCS survey instrument, significant portions of it, have been fielded in a probability-based panel that's run by RAND. It's the American Life Panel. And so that was fielded in 2012, 2018, and it's right now in the field using the 2024 questions. And so that gives the opportunity for longitudinal data. But you can use that data set and the NFCS data sets to do causal statistical analyses. The question was asked, I believe, by Vice Chair Calabria, does financial education work? Is it making a difference? Is it changing behavior? Well, we do see that people who have higher levels of financial literacy over time, it actually predicts financial outcomes. Looking at that longitudinal data and looking at the NFCS data, we're able to see that, there have been research done by external researchers and the foundation that look at the impact of financial education mandates that states have been implementing. Just over half of the states have mandatory courses that students are required to take to graduate from high school. And using a differences in differences analysis, we're able to establish that those students who were exposed to mandatory financial education, in fact, have better downstream credit behaviors. They're less likely to be overcharging. They have better debt behaviors, and there are many more ways. There are all kinds of econometric techniques and statistical analytical techniques that you can use to slice and dice the data. So the QR code will take you to the Foundation's Research Center, and with that, I thank you very much for the opportunity.
Thank you very much, Jerry, and I want to highlight that, for all of the people that would like to do financial education program, I very much recommend this data and the questions in the data, because if they use them, then they can compare their initial finding, for example, with a representative sample of the US population. The data is so large that, if you're looking at a specific subgroup, then it's possible to do that. And in fact, it's even possible to look at the statistics already reported, and so you can do a lot more targeted program. And I must say the targeted program are also the ones that are likely to be more effective. Our data set as well, the Personal Finance Index, very much benefited from what we have learned from the National Financial Capability Study. We extended the measure of financial literacy. So by the way, yes, it's possible to measure financial literacy, so we can track progress over time. And a lot of the indicators, for example, of financial well-being, including the CFPB measures as well, are present in the National Financial Capability Study. I want to say what a great service to all of us to have this source of data provided every 3 years. And with that, I want to turn to David, and actually I'd like you to see that this important program done at HUD, and I cannot think of a more important topic today than helping people buy their homes and advising them, and potentially, particularly, buying their first home. I must say, I just had to make the decision about buying a new home in Palo Alto, and that was not easy.
Thank you for helping me out with that. Thank you, Dr. Lasardi, and let me acknowledge the strong work of the Commission members, the agencies, and also acknowledge the work of Secretary Bessent, Deputy Secretary Falkender, Director Calabria, Director Curtis, Chairman Hill, Controller Hood, and Sharon Haltman. It is a pleasure to be here with you today to discuss the HUD Office of Housing Counseling's approach to measuring the effectiveness of our housing counseling and homeownership education programs. HUD's Secretary Turner has stated, "God blessed us with this great nation, and together we can increase self-sufficiency and empower Americans to climb the economic ladder toward a brighter future." Secretary Turner has also affirmed that, to quote, "The primary mission of HUD is finding long-term solutions that provide affordable housing, spur business creation, and rebuild prosperous American communities across our country." Housing counseling plays a crucial role to realize these goals by enhancing financial stability and ensuring housing security, leading to a reduction in the reliance on government aid and the promotion of economic opportunities. This strategic investment not only benefits individuals, but also strengthens the fiscal health of our nation's financial institutions and housing providers by fostering well-performing mortgages and tenancies. Moreover, housing counseling encourages personal investment, which in turn bolsters community stability, strengthens personal financial well-being, and equips individuals with essential financial management skills. HUD funds and provides technical assistance to a strong national network of approximately 1,500 HUD-approved housing counseling agencies and over 4,500 housing counseling professionals. These HUD-certified counseling professionals provide independent expert advice customized to the needs of around 1 million consumers on average every year. Housing counseling services can help consumers with financial management and budgeting, credit counseling, obtaining and maintaining homeownership, and avoiding mortgage delinquency. On that note, I'd like to respond also to Vice Chairman Calabria's remarks about the increase in funding during the financial crisis, and it was in response to the counter-cyclical emergency at the time. I will note that housing counseling organizations with support from Treasury, HUD, and the private sector helped over 12 million Americans sustain their housing. And more recently, during the pandemic, hundreds of thousands of Americans with Treasury support and programs and housing counselors once again proved the worth of housing counseling programs. I'll also note the importance of down payment assistance as I switch into home ownership as a goal for our organization, for HUD, for all of us collectively to help our communities. Across the country, there are over 2,000 unique down payment assistance programs. And across the board, they uniformly require housing counseling as a component. Why? Because more and more data sets are documenting how housing counseling impacts sustainability and long-term success financially for the families who benefit from it. I'm going to highlight some of our more recent efforts. Unfortunately, in the area of home ownership, there has been rather limited education and research in this space, unlike foreclosure prevention. In particular, I note two studies from our own Office of Policy Development and Research. One is a study called Housing Counseling Works. It's more a white paper looking at major efforts across the past decade to document the impact of housing counseling. It's a must-read in this space, and there's a link to it on our HUD website if you're interested. Over a 10-year period of time as well, our Office of Policy Development and Research conducted a long-term randomized experiment or demonstration following over 5,800 consumers. It wasn't a true study of housing counseling. It looked at homeownership education. The group of consumers who were studied had already been approved by financial institutions for mortgages, but still it's very instructive. Individuals offering counseling were more likely to be confident that they could find the information they need about home buying. They report being very satisfied about the home buying process. They knew that they could speak to a housing counseling agency before and after realizing home ownership, and as well in the long term, particularly for youth, folks that were younger purchasers below the age of 29, there was a higher rate of home purchase in the group. There were lower rates of 60-day mortgage delinquencies, and there were fewer derogatory events because those consumers contacted their servicer or spoke with a housing counseling organization. We fully agree that there is a need for more data in this space, and that has been the focus of our office over the past 4 years. We do follow over 19 different areas, it's growing, of, in fact, what I'll call outcome information. And here's some generic data from our program that you can take a closer look at. I apologize for the size of the PowerPoint slide, but we look at outcomes in general counseling and all the work that we do, whether it be disaster relief, home ownership, whether it be foreclosure prevention, elders to sustain their housing and age in place, working with, in fact, populations who are in the armed forces and others. We also are looking at post-purchase counseling. That has been very instructive, and we have information from the government-sponsored enterprises and mortgage servicers that follow-up counseling in the post-purchase space, in fact, is a model standard, which I'll speak to more in a moment. Rental counseling, of course, is a very important focus, whether you're looking for affordable rental housing or home ownership. We work with multiple populations, both in urban and rural areas, and in particularly during the pandemic, we had quite an impact working with Treasury to ensure sustainable rental and tenancy situations. And tenancy counseling, disaster counseling, we've been doing a lot of place-based first responder work. So we're expanding our relationship with local disaster response centers, with FEMA and others, and for the first time putting counselors on site as well as having responders on our 800 number, and it is proving quite impactful. Now, each year, as I noted earlier, we approximately serve 1 million people. The numbers go up and down depending on funding levels, depending on private sector support. For each dollar of federal support, about $10 of private sector support housing counseling. But overwhelmingly, the majority of sessions are targeted towards pre-purchase counseling, whether it's group or whether it's individual counseling. Based on the desire to capture more data, both something that we're committed to, particularly outcome data, as well as efforts to expand home ownership, I'm very happy to report about a new demonstration that we have begun. It's actually a new grant program that we launched just in the past year and a half. We are currently awarding grants to 21 housing counseling intermediaries. Those are groups that are national or regional that flow funds to local programs or affiliates and also HFAs. For the first time, we are going deep with data collection. And you're going to have a preview today of, in fact, data pulled from the first 1,600 new homeowners who we have realized homeownership for. First, this program is a change-up. We have a negotiated fixed rate, what the private sector would call a fee for service, and among the requirements are offering pre-purchase and post-purchase housing counseling, and mortgage origination. You must originate a mortgage in this program. It is one of the requirements. Notably, it's been very, very interesting. Among those first 1,600 or so homeowners, we have gotten some amazing data. I'm going to start with the one that really excites me the most, following the FICO score. Now, I have two numbers to share with you today. We are collecting FICO. Of course, it's based on consumer willingness to share it. So first, we have an average number across all of the loans. And then we have a second number where consumers have provided FICO scores pre-purchase as they started counseling, and we have captured it post-purchase. Now, those post-purchase sessions are still underway, and we have a goal of realizing 5,000 homeowners with the 22 agencies. This data is from the first 7 agencies who have reported. So, on average, among these homeowners, from first contact to homeownership, they experience a 25-point increase in FICO score. And where we have data from homeownership through homeownership and pre-purchase, it is a 44-point FICO increase. That is hardcore evidence of the impact of financial coaching and counseling and homeownership education. What's very interesting as well is the consumer base. We were hoping that we would reach HUD's traditional consumers. And in fact, if you look at the average median income of consumers, almost all of them are in the 40 to 80%, the majority of them, of the typical area median income, the sweet spot that we were hoping for, because there was some concern would the very qualified simply be cherry-picked for this program. And then 80% of the consumers so far in this program are first-time home buyers. Very interesting data coming through. Now, the average loan was about $280K. Average interest rate, as you see there, was about 6.5%. Down payment assistance, where it was separate from the loan. Many mortgage products today are incorporating down payment assistance, such as the NACA product, into the mortgage product itself. But the average down payment assistance was $15,000, and the average monthly mortgage payment that we've captured was about $3,900. Interesting stat here as well. Of course, many consumers are mortgage ready when they go to our counseling organizations, but many receive multiple sessions and in fact may receive counseling over months or over a year. The average number of sessions to date that have been documented is in fact 5 sessions before the individual household realizes homeownership. And on that note, I want to simply close by an acknowledgement, because we are committed to capturing more data. We are committed to doing it not only in homeownership, but across our entire program. And we're very appreciative of the support of our Principal Deputy Assistant Secretary, Frank Cassidy, in the Office of Housing, because he is supporting our efforts to report out on this data. And you can look for a white paper in the very near future as we continue to decipher and digest the initial data sets. Thank you very much.
Thank you very much for this presentation and for touching upon this very important decision, in particular for first-time home buyers. And I think what is also very clever is to provide information on things that really matter. And I wanted to tell you that after having seen all of this work, and we are following your work for a long time, since this started quite a while, we teach an entire class in our personal finance course about the FICO score. Right, that's really a very important information that every person should have, but in particular if you are actually making the decision about buying the house. So this is clearly very important and very clever. And in that respect, let me turn now to the FDIC, because as also Acting Chairman Hill has mentioned, the work that has been done with the Money Smart program is certainly very important. And this gamification in particular, I think, has been a very innovative way to engage everyone in financial literacy. Susan.
Great, thank you. And thank you to everyone on the Treasury and the FLEC teams for the opportunity to speak today. Although probably not supposed to lead with this, but I'm just gonna let you know, sometimes public speaking is not my favorite. I hear that's normal, so it's okay. But I realized when I was getting ready for today that I think I'm okay with it in this case, and that's partly because I'm really proud of the program evaluation work that's been done at the FDIC. I'm really happy with my collaborations with my consumer education colleagues, especially Ken Worthy and Christina Miranda, who I just want to mention because they've been really key partners with me in this research. And I'm just really genuinely excited to be able to share some of our findings with you. So it's going to be good. It's going to be okay. Now, I think as many of you know, the FDIC has had a long-standing commitment to financial education. Chairman Hill discussed our Money Smart resources. They've been available for nearly 25 years, and we have resources really for everyone, something for all ages and stages of life. But today I'm going to focus very specifically on How Money Smart Are You? And this is our online asynchronous financial education tool. It's a self-paced suite of 14 financial education games, and it's based on the Money Smart curriculum, and it's suitable for adults of all ages. And these games focus on building really foundational knowledge and skills that consumers need to confidently manage their finances and to make informed financial decisions. The How Money Smart Are You follows an interactive game show experience. So it allows players to explore real-life financial scenarios. They answer questions, and you win coins for getting questions right. You ultimately earn certificates for winning and completing games. And just by way of a little bit of background, the development of these games was a really thorough process. I mentioned that they're built on the Money Smart curriculum, and we previously evaluated that curriculum and found it to be effective. So it was really important to us that we used that tested content as the base. From there, we built the games towards recognized, standards-aligned learning outcomes. We drew from financial literacy research and educational best practices. So we really put a lot into developing these games in a thoughtful, research-informed way, and that did give us a lot of confidence that we would see the outcomes that we hoped for. But of course, we didn't want to just assume that. We really wanted to get out into the field and to measure and to test that. So once How Money Smart Are You had been out in the world for a few years, we thought the time was right to undertake a really rigorous evaluation to see how and whether it was working. Our primary objectives for the program evaluation were to assess whether and to what extent playing the How Money Smart Are You games impacts key financial outcomes related to knowledge, attitudes, behaviors, and well-being, and also to learn about the experiences that consumers have when they're playing the games and the experiences that organizations have when they use these games with their own students or clients or employees. The centerpiece of our evaluation was a longitudinal quasi-experimental study. I like to say that because it sounds fancy, but basically it involved participants playing 3 key How Money Smart Are You games. Those focused in on basic banking, on spending and savings, and on building and managing credit. And they completed 3 surveys at different points in time. So they did a pre-survey before playing any of the games. They did a post-survey soon after completing the games, and then a follow-up survey 3 months after that. And we also had a comparison group who did a baseline and a follow-up survey. And that allowed us to do a difference in difference analysis, where we looked to see whether there were changes from the baseline to the follow-up and whether those changes were different between the treatment group who did play with How Money Smart Are You and the comparison group who did not use the games. And this wasn't the only data we collected. It was a mixed methods evaluation. So we also conducted focus groups with consumers. We fielded a survey of organizations, and we did some interviews with organizational account holders. So we really could get a very full range of perspectives. I personally think that collecting this qualitative information was really valuable. It was a great complement to the quantitative data. And as you'll hear, those findings not only confirmed some of our results, but also gave us some really additional context and deeper insights. Okay, so that kind of felt like a lot of setup, but now onto the findings. We found that playing How Money Smart Are You did have significant and meaningful positive impacts on consumers' subjective financial knowledge, financial skills, financial well-being, and I think really importantly, financial behaviors. For example, we found that use of a budget improved from 57 to 69% after people used How Money Smart Are You games. And our rigorous evaluation methods showed that users had a 3 times greater odds of having a budget relative to non-users. The share of consumers saving regularly increased from 52% to 62%, meaning that users had 8 times greater odds of saving regularly relative to non-users. And emergency savings possession grew from 66 to 71%, which meant that the odds of having emergency savings was 5 times greater for How Money Smart Are You users relative to non-users. Notably, in many cases, these results were larger for people who had lower scores at baseline, which I think is important because it suggests that the impacts might be particularly effective for those who are most in need. And these quantitative findings were confirmed by our qualitative findings. The focus group participants often talked to us about how much more confident they felt in managing their finances. But what really stood out to me in listening to them was how often they were able to tell us about very specific changes that they had made. I have just a few quotes I can share. For example, one participant told us, "I definitely budget better monthly for myself. I know how to prepare my own balance sheet." Another talked about savings. "How Money Smart Are You helped me learn how to save money and actually break my check up. I can be like, oh, this is what I can use to spend on bills. This is what I can use to spend on myself and then have savings." And another talked about credit. They told us, "It raised my credit and I got my credit limit increased. I feel like that's what really helped me become more financially literate. It was about saving my money and then knowing how to use a credit card properly." We also heard from organizations that they were seeing evidence that How Money Smart Are You was having an impact on their clients. One organization told us they actually do their own financial education testing, and they saw those scores increase after their clients were using How Money Smart Are You. Other organizations told us that their clients better understood certain terms, had better financial plans for themselves, or had better understanding of sort of saving for wants and meeting their financial needs. So we not only saw the analytic results, but we heard people describing these outcomes in their own words, which I thought was really, really powerful. Now, I mentioned we not only wanted to learn about the effectiveness, but also about the experience. And we found that consumers and organizations are really highly satisfied with How Money Smart Are You. The vast majority of users enjoyed playing the games. They would recommend them to others. They called them fun. They called them lighthearted. Importantly for us, participants also felt that the information was trustworthy. They told us it was important to them that the information came from the FDIC, which was an established financial agency, and that was something that gave them confidence in the information. So just in wrapping up, I can reflect on a few highlights that resonate with me, both in terms of implications for our own financial education efforts at the FDIC, and I think implications for financial education stakeholders more broadly. First, through the evaluation, we were able to find some very specific opportunities to improve and to adapt to evolving user needs. For example, we heard about specific features like pacing and navigation tools that were really important. Both consumers and educators wanted some more control and some more options there. I think it's also notable that the evaluation kind of confirms that there's a real demand for asynchronous online financial education and that this can be an effective and desired delivery mechanism. Although I do note that I think evaluation of the effectiveness of this channel relative to other channels is probably an important area for future research, so I'm doing my thing to keep the research community busy for a little bit longer. Finally, I think thinking even more broadly, I just feel like doing these types of evaluations and experiments and projects and making these results public can both improve financial education practices, but also can encourage people and motivate people to make use of the resources. I just think if people know that something works, they're going to be more eager to use it and to engage. So with that, I just really hope that we all continue doing and talking about this important type of work.
Thank you so much for these descriptions, and I really recommend everybody to check out the 14 games that are available on their website. One of the things also I want to say, one of the big problems of financial education is engagement. And also the fact that often we teach or we attract those who are already converted. And so what the gamification really does takes away so many of the problem of financial education that is perceived potentially out of reach. People think it's too difficult, it's taboo, or as my students say, it's not cool. But I think we can find a way to actually take down those barriers. So thank you very much for what FDIC has done over time. And now we turn to the DOD,
Thank you, Mr. Secretary, Mr. Deputy Secretary, fellow FLEC members, esteemed panel. I stand in awe of all your work. I am well aware I am the closer. Okay. So I am from the Department of Defense, Office of Military Compensation and Financial Readiness. Responsibilities of our office are simple: train, counsel, and assess the financial literacy programs that support all service members and their families. Requirements for these programs are statutory and contained within 10 U.S.C. Section 992. Department policy and implementing guidance can be found in DoD Instruction 1322.34, Financial Readiness of Service Members. Financial literacy training is provided at various personal and professional touch points throughout a service member's career. Training is comprehensive, starting when a person decides to join the military through to transition from the service. It is developed by each service and delivered via multiple modalities, such as traditional classroom, service online portals, or during a meeting with a financial counselor. Training is tailored to the point of need and includes such areas as consumer protection, planning for the future, and major purchases. Law requires the department submit an annual report on the status of the financial literacy and preparedness of the forces. Data for this report is generated from the Status of Forces Survey, which contains questions covering a broad range of financial literacy topics. Using the data, the department evaluates the overall programs, informs policy, and identifies training needs. The Status of Forces Survey provides a strategic view of military financial literacy. It does not provide data on individual training sessions. The 2024 report was sent to Congress just last week, and we expect to have it publicly available later this summer. So I'm sharing data from the 2023 annual report. Note, the data for this report was collected from July to October 2022. So what exactly does this data tell us? The overall financial condition of the force is comfortable for both the active and reserve components. Looking at the CFPB financial well-being score data, where scores of 50 or below indicate a higher likelihood of difficulty making ends meet, again, the status of the military indicates a higher well-being, aligning with the financial comfort data. From this perspective, it suggests that DoD financial literacy training and resources are effective for most service members. The department also looks to examine specific financial behaviors, such as establishing an emergency fund and credit card usage, to provide a more nuanced and objective examination. Both the active and reserve components indicate high percentage of having an emergency fund. The survey then asks, how much is in your emergency fund? Again, a relative high percentage, around 70% of service members indicated having at least 1 month or more of emergency savings. Looking a bit deeper, the data shows that approximately 35% of respondents have 4 months or more of emergency savings, and 35% have between 1 to 3 months of emergency savings. This gap indicates actionable data to help re-examine our learning objectives and their placement, adjust curriculum content, and develop strategic messaging focused not only on encouraging the establishment of emergency fund, but also the considerations to determine how much is needed in an emergency fund. The Status of Forces survey data also tells us that credit card use is very high among service members, but how do they pay? The department actively uses strategic messaging and curriculum content to emphasize the importance of paying credit card bills down and on time. From the survey data, we can see that approximately 80% of service members either pay in the full balance or more than the minimum each month. Minimum-only payments and failure to make a payment in the last year do need attention, but the percentage of service members affected is small in proportion. Additionally, approximately 11 to 14% of service members indicated they do not use credit cards at all. Overall, it appears the department's efforts are effective in promoting healthy credit card habits. Again, thank you for this opportunity to share some insights into the effectiveness of the department's financial literacy programs. As mentioned earlier, we expect that 2024 annual report to be publicly available sometime this summer. It'll be posted on our website, and come connect with us. Thank you.
Thank you very much for the work that DoD has been doing for such an important aspect of making sure that, for example, our military is also financially ready. And I think, what we have heard today is a need for financial education, but also evidence that we can make financial education effective. And I'm going to use just a minute now and ask each of you to say, what could be, given your experience, how can we make the financial education effective? One potential suggestions from your experience as well, and it's just going to be our, in a sense, final comment. And I'm going to start by saying, in order to make financial education effective, we need measurement. We need to make sure we know what works, and so that we can continue to improve and we continue to do better, and we can also show what success looks like. Jerry.
I agree, and I will add that one size does not fit all. If you're in high school, if you're in the workplace, there are different needs that you will have at different points in your life. So we need to be mindful that audience segmentation is key.
I'm going to share two thoughts today, one simple and one I think we have a lot of opportunity to build on. The first, consumers need to shop around. It gets to the earlier conversation today about disclosure and being thoughtful about purchases in your journey during life. So many consumers come into housing counseling and they've only received one quote for a mortgage, or in fact, they're responding to a realtor's recommendation, perhaps to buy too much home. By being smart and thoughtful and deliberate and shopping around, a very simple step, we can take full advantage of all the responsible players in the marketplace. The more exciting opportunity that I'm seeing right now is how housing counseling agencies are beginning to work with fintech providers to bring credit counseling and financial education models in to help develop electronic wallets to plan not only for that moment in time, but for the long term, through a mortgage origination, all the way through retirement are some of the discussions going on right now. And I note how important that is because of the growing need of elders and seniors in our society. The reality, as we know, is baby boomers have not saved enough in our society for a healthy, vibrant financial retirements. And it's a challenge we have to work on together as well moving forward. And I'll conclude on that note.
Thank you. Great. And I guess building on what a lot of my fellow panelists have said, I think that effectiveness will continue to grow if we continue to get these tools into more and more of the right hands. And no program is going to be effective in practice if no one is using it. So letting people know that the resources are available, making sure that consumers are aware specifically of the key features that are important to them, I think is going to help and is going to drive engagement. In our case, we learned that people valued the trustworthiness of the information and how money smart are you. They valued the fact that it was a fun experience and enjoyable. So improving outreach in sort of targeted ways that let people know that these attributes are out there is going to be helpful. If people know that it's fun, if they know that it's reputable, that will drive them to make more use of the product, and I think will ultimately just spread the reach and help effectiveness.
Yeah, building off what everyone else has said, not only do we need to continue to take measures of effectiveness, but we need to look at them and apply them and think about how we can use them to improve our programs. But I also think one of the best things we can do is the idea of meeting people where they are, echoing what's been said here earlier. People are going to go on different journeys. They have different background expectations. They meet different challenges. So we need to be mindful of that to provide them the education they need at that point in time. But also the idea of letting them receive the education in a manner in which they want to, such as maybe with the Money Smart, or maybe it's a in-person class. Having that education be available in multiple modalities, I think, is also an important aspect to consider. Thank you.
Thank you very much. I just wanted to say to Secretary Bessent how excited we are to be here today. And if I had to summarize what this panel has told us, is that it has told us that financial education is possible, is cost-effective, and puts the American on the path to financial security. So thank you so much for convening this meeting today. And the work of FLEC is certainly very important for achieving that financial security for all.
So I want to thank all of our panelists. The conversation today did highlight the transformative effect that impactful financial education that increases financial literacy can have on people's lives. And with that, I'd like to turn it over to the Secretary of the Treasury and Chair of the FLEC.
Good. Thank you all for being here today. It's an honor to be with you. Promoting financial literacy is among my top priorities as the 79th Secretary of the United States Treasury Department. Why am I so passionate about this subject? When I was a young boy, my family fell in hard times. Growing up in South Carolina, my father made some risky investments that put us on our back feet financially. His career was a riches to rags kind of story. And when it was rags, the whole family suffered. So I did my part to help support us. Believe it or not, I began my first working age job and received my first W-2 at age 9. I actually filed my first pay stub for this job just the other day. I was in New York last Friday speaking to a group of community bankers, and we were talking about the importance of financial literacy and the good work that they do within their communities. And one of the bankers, a very enthusiastic gentleman from Long Island, suggested that we should change the name from financial literacy to financial mastery. I like the term the professor just used, financial security. So knowing how to save, invest, and build wealth over time is the key to unlocking the best future for all Americans. Money, i.e. financial security, gives you freedom. And when you grow your money, you grow your freedom. And that's why I believe financial literacy is core to the American dream. Keeping a budget, saving for a rainy day, investing in the stock market, and planning for the future. These are the small things individuals can do now to do big things in the future. This is the pathway to financial security and the pathway to a stronger, more prosperous America. Expanding financial literacy amongst our citizens will have a positive bottom-up effect. Financially responsible citizens will demand financially responsible leaders, and many of them will become those leaders themselves one day. And on a side note, I would say the ever-increasing range of financial assets and products, from digital assets to buy now, pay later, and I think the complexity that is now involved with keeping a budget, maintaining the household financial integrity is greatly complicated and becomes more and more complicated every day. That's why the work we're doing here is so important. This commission must determine whether federal programs and policies designed to expand financial literacy are actually working. The diligence we bring to this task will shape our country's financial future and in turn the future of our children and grandchildren. This afternoon's discussion is in many ways a return to the founding purpose of the FDIC. Congress established this commission to coordinate and assess the effectiveness of federal financial literacy and education efforts. Our panel today will highlight findings of the 3 FDIC agencies. I enjoyed hearing them, I look forward to hearing them and watching the videos, and I look forward to learning more about the efforts of all the 23 agencies. The representation here today from a wide array of government organizations affiliated with the FDIC is important. We each play roles in our respective offices, but let's not forget there's only so much we can do through the arm of government. That's why state, local, and private institutions are crucial. Only by working in close partnership with them can we expand financial literacy to the families and communities that need it most. These state and local organizations are boots on the ground. Because of them, the majority of states now include a course in financial education as a high school graduation requirement. This is excellent progress, but we still have a ways to go and we need to get there together. Let's take stock of the progress we've made today, then let's discuss what more we can do to empower citizens to achieve the American dream through financial literacy and mastery and ending with financial security. So with that, I'll hand it back over to the Vice Chair, Mark Calabria.
Thank you, Mr. Chairman. Let me open it up. Well, first of all, let me thank the panel. I appreciate all the remarks. That was incredibly helpful. I'll use this moment to perhaps ask a question. The phrasing of our panel is the efficiency of programs. My question is kind of the efficiency across programs. Some programs are delivered in person in classrooms, some are delivered online, some may be delivered partnership with industry, some are delivered just before or around purchase. And so I would be curious to hear what the literature has to say in differences across those various characteristics within programs.
I'm going to start with some academic research on this topic and actually showing and echoing what Jerry had said, that it's really important to design programs which are suitable to the target population. For people that think that there are huge differences between in-person and online, surprisingly they are not as large, and I think we see a lot of promising in, I think, various methods of deliveries. So when it comes, for example, to the high school and to the college, we have seen a lot of promises in that part. I think programs that really meet people where they are, I think are particularly successful. And this is why, as we think of all of this program, this is something that we need to consider. I also want to mention the spillover effect that we see also of the programs. And I think there might be even spillover across these groups as well, because by, for example, informing young people about home ownership, we might actually have some spillover effect in other financial decisions. We see, for example, when we teach personal finance at Stanford, 1/4 of our students are first generations, and so that knowledge is brought back to their parents and their community as well. So I think we need to think a lot also about the spillover effect.
I'd just like to add that, the meeting people where they are and being creative and letting financial education be fun at times can be helpful. That's certainly true with children. We have a partnership with the American Library Association to deliver digital and in-person programming. And again, it's under evaluation right now. We'll have the results shortly, but we've seen from previous iterations of this that the two can be the same. But just recently, the program manager was telling me about, 6 to 8 year olds learning by playing a game about insurance. And that was the thing that they were most engaged about. And how amazing is that? Through workplace efforts that we've been doing, we've been finding that, leveraging not only the employer and a local financial institution, often credit unions actually, but having a nonprofit that can be a resource coordinator can help people where they are so that, again, even within a single workplace program, it's not a one-size-fits-all element. And I'll just close by saying I thought I'd never meet anyone who had their first job at age 9, but I did too.
Mr. Secretary, pleasure to see you, and thank you for your remarks. 2 quick points. One is a personal one. I think we in government should not be afraid to innovate and partner with the private sector. Too often we're in this separate world, and I think the key to our office's culture has been given the freedom to innovate at HUD. I think about a recent graduate of an HBCU, a student. When I first met him, he told me that he never valued the concept of home ownership. And I asked him why, and he had just completed a home ownership education program and counseling with one of our organizations. And he told me the story of how he was foreclosed upon. His parents were foreclosed upon during the financial crisis, and he was prompted and had to move into his grandparents' home with his entire family. And so he didn't value homeownership, but how the homeownership education course was an awakening for him. And when I saw him again, he is graduating from college, and as a new graduate entering his career, he bought his first townhome. That's the magic of what we all do together. The other aspect of, I think, what's really important in the work that we do, and something to consider as we move forward, is that it's okay in government to try something new, like our new home ownership initiative, and adapt and change on the move. And then we are more successful. And again, I'm very appreciative because we have leadership at HUD now that is allowing us to really streamline programs and get the job done. Thank you.
Thanks. I think the research question regarding the effectiveness of financial education delivered in different methods is a really, really interesting one, and I think there's no single right answer to this. As has been mentioned, I think there's some evidence in the research community that different channels can be effective, and we've even seen that at the FDIC. Today I talked about our program evaluation of How Money Smart Are You, which is the technology-based, asynchronous digital product. But we previously evaluated our Money Smart curriculum, and we did a longitudinal evaluation of the in-person instructor-led Money Smart, and we found that to be effective. This was almost 20 years ago now, closer to when that product was first introduced, but we found that participants who took that classroom-based training were more likely to open bank accounts, were more likely to be saving, were more confident about managing their finances. So again, I think there's no right answer. I think having many different types of resources available for different people and just having a lot of options is really going to be the key.
Please.
Okay, sorry. Yes, I agree with all that's been said, but I also want to echo some of the opening remarks where we're talking about some of the difficulty and the talking about money being taboo and how important it is to bring fun even to the adult. Okay, so that it is a less stressful environment because you'll have better learning outcomes there as well. Thanks.
Thank you all. The secretary needs to depart, so we want to thank you very much for your participation and your wise words to us. Thank you.
Good, and thank you for all of you are doing. Good, thank you.
Well, I think we've got a few minutes for other panel members, commission members who may have some discussion. So if there are questions, I'm happy to recognize other members. Well, if not, I'm also happy. Kyle?
You don't want to be the guy that keeps the meeting going longer than it's supposed to, you know.
I'm not necessarily encouraging other questions. Just open it up.
All right, I'll just throw on can I ask how often you encounter people, part of the reason they're up against it financially is because of charges by government itself. The state and local in particular, the federal government is not that bad. For example, every state in this country that has a usury limit for lending, they all have one thing